This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Tripp Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Well, welcome back to the podcast. Tim, it's good to have you back after you took a break this last week, spent some time with your family on spring break.
It's great to be here. Yeah, we had a good time. We were down in Punta Mita, down in Mexico, kind of by Puerto Vallarta. So got down there on the beach, and it's really beautiful, kind of relaxing. So it was good to get out for a little bit and get away and get some good family time. But I'm excited to be back.
I'm a little jealous. It's been extremely windy up here in Dallas, and the weather's been fluctuating. So I'm sure it sounds like you guys had some good weather while you were down there.
Oh yeah, we didn't have any rain. It was beautiful. It's pretty because you have the mountains there, some pretty big mountains in the ocean. So it's a really cool setup.
That's great. Well, Trey did a great job filling in for you last week, and we just kept it focused on Dallas. We talked about activity that we've seen this first quarter, and it was a fun episode. I think we both left that recording just feeling excited to get back to work and talking about some of these deals and just the activity in the market. We're in a very different place than we were 12 months ago. And I know we're going to hit all of Texas today, so we'll spend more time talking about Houston and Austin and a little bit more about Dallas. But maybe we start with just today versus about 12 months ago for Houston, because that's a pretty big difference.
Yeah, I think what's interesting, when you say that, we felt last year at this time like the market was coming back. There's a little bit of a bounce early in the year last year. A lot of groups were active trying to find sites and maybe tying a couple sites up. There was a belief that rates would fall last summer and we'd see the market recover a little bit quicker. We were hoping that would be the case, and that didn't happen. And so a lot of stuff fell out, or just never materialized last year at this time. This year's different. I mean, we're seeing a very strong market like we talked about, I guess, a couple of months ago. We were getting into this quarter. What we believe would happen is happening. I mean, we're seeing strong offers. We're seeing deals going under contract across all the use types. I would say it's an acceleration of where we were back in 21 and 22, where we're seeing even stronger pricing in some areas. We're seeing a bigger appetite for deals. So it's been really exciting, and I'm looking forward to. It's one of those times in the market where it's fun to be out on vacation, but then you're like, we need to get back and get to work because there's a lot to get done right now.
Yeah, you definitely feel like, and this is what we've been telling our teams, is you don't want to miss this opportunity. This is when the market's building, the activity's building, and we've been in the business long enough to know that it just doesn't stay as positive as it's been or it's going to be. And really, this is when you want to be putting deals together. You want to be out selling, because you need the market to still be a good market when it's time to come to closing. I think a lot of people don't realize that. If you wait and you're making a decision to sell, or if you're a broker and you're really focused on the top of the market, and obviously you have to keep working hard regardless of the market, but a lot of those deals that you sign up at the top of the market don't end up closing because naturally you just, the cycle catches you, and you want to be more in the early part of the cycle to get to closing.
Yeah, we're very sensitive to that. I mean, it's kind of funny because people always want to wait and they always want to time it perfectly, which is impossible really in any business to time it perfectly. But we talk a lot about the early cycle deals, or the deals that have the lowest transaction risk. That's where there's just the biggest opportunity for the seller and the buyer to get something done. And as you get late in the cycle, sometimes you do time it perfectly and you get, just the top of the market and the deal closes right as everything's starting to kind of come back down. But a lot of times those are the deals that fall out. And that's actually when you have the lowest or the highest transaction risk, in those kind of markets. So this is a great time for sellers to be out in the market. I think especially the next 60 to 90 days. We have a couple listings we're taking out right now we're really excited about. I've told the sellers, you couldn't be going out at a better time. You go out after spring break, before the summer, there's groups already making offers, and we have listings we're taking out. We're getting offers immediately. Nobody's waiting for a call for offers or anything. They just want to get deals. And so this is a time to go hard. And then, we have the summertime is always, it slows down a little bit. I have a feeling this year it may not slow down because I think we'll see momentum carry through the summer and into the fall.
Yeah, that's exciting to think about. Well, we can start with just some of the stats, what we're seeing across the state from an activity standpoint. And we talked a little bit about this last week with Trey when we were talking about Dallas. We're recording here still with 10 days or so to go in the quarter. So these aren't final quarter numbers, but really strong numbers coming in. We said a couple months ago that we felt like we were at the beginning of a pretty strong upward cycle. And I think this first quarter is really proving that out. So like from the offer standpoint, both Dallas and Houston have had really strong offer numbers to start the year. And those are, going to probably approach high 100s, close to 200 offers by the end of the quarter is where we're going to end up. And it's interesting because we pulled the numbers and they're like within 1.5% to 2% of each other between the two offices. So it just goes to show the type of activity that we're seeing. And we'll get into that in a little bit, just what type of offers are those and who's making those offers. Central Texas has been a little bit tougher. Those guys are still going to record close to 100 offers in this first quarter, but that market's just more difficult right now, and we'll get into a little bit more about that. I don't think that's a surprise, just because they've had so much development, so much supply in kind of every use type. So they're just hitting a little bit of a headwinds right now compared to maybe Houston and Dallas, but overall really strong. I mean, we'll finish close to 500 total offers across the state in the first quarter. So we'll be on track we like to be around 2,000 offers when the market's strong. And like to your point, I'm hoping that we'll even see stronger offer metrics in Q2, because that's always the beginning indicator of just how aggressive clients are being.
And the difference, I think, you talk about different times in the market where there's a higher hit rate or a lower hit rate. This is a time in the market where there's actually a pretty high hit rate in offers because developers are getting more aggressive. Their pricing is starting to go up. The timing of the contracts is contracting. So we saw the last 2 years, developers were asking for a lot of time, a lot of feasibility, a lot of time to close, a lot of extensions built into deals. We're seeing that contract considerably and the pricing go up at the same time as you have some sellers with some fatigue, and maybe they've been trying to sell for a while now. They've been seeing weaker offers. Now they're starting to see stronger offers from good sponsors. And so now we're seeing, a higher hit rate on those offers. In some cases, we're seeing some surprising offers that are kind of surprising us with how aggressive some groups are getting.
Yeah, that's a great segue into the next metric that we like to talk about. It's just deals added. So when we talk about deals, we're thinking about, deals that are getting signed up, moving to contract or going into contract. And so across the state, we've added, I think, close to 70 deals in the first quarter, which is pretty incredible. So on pace to add, that would be, a couple hundred deals by the end of the year. So really strong. Dallas has led the way on that. I think we talked about that last week. We're at around 30. Houston are going to be a little over 30 by the end of the quarter. Houston is going to be a little over 20 deals added by the end of the quarter, and then Austin is just a little bit below that. But we're seeing strong deal activity. A lot of those deals that we discussed last week in Dallas have been multifamily and industrial, but the single family market has stayed really strong as well. In Houston, what are you seeing from a use type standpoint as far as deals being added?
I was looking at it this morning. It's actually pretty even. I mean, it's probably heaviest on the multifamily side, but single family is really close. And some of that is we have deals that have gone or contracted and deals that are pending. And so it kind of is like, which ones are actually being added at which time may kind of shift that one way or another, but very strong single family activity. We have about 10,000 acres of single family land in the pipeline right now, and we're targeting another couple thousand. So we're hoping to get to 14,000 this year, at least under contract. Some of those deals will close probably next year. But really strong activity, big offers, $100 million, kind of deals on the single family side. And then multifamily, we're seeing, really aggressive offers in the suburbs. It's been a little bit slower on the infill side. We are seeing some pretty good offers on core infill sites. There's still a disconnect between the buyers and sellers in those markets because sellers want just huge numbers that aren't reasonable today for multifamily. Industrial, we're really starting to see it pick up. I would say it's a little bit behind those other two uses, but we're starting to see it catch up pretty quickly, and even seeing pricing into the teens on some sites, like core kind of infill suburban industrial sites. So across the board, it's been some good activity, a lot of offer volume, kind of all around.
And we spoke pretty directly to that on last week's podcast for Dallas, but I'll attempt to cover Austin for Trip. Trip's getting married here in about a week, so we're giving him this quarter off. But we do want to have him back on here soon. He's just been very busy, and we're excited for him with that big life event. But what we were seeing in Austin, the metrics are not quite as strong just on the offer and deal front as Houston and Dallas, but a lot of that has to do with, it's definitely not as large of a market. And then the market itself is just going through more change with the amount of supply that they have and just the amount of product that's been put on the ground. But that to say, our guys have done a good job of converting, from a percentage standpoint, converting a lot of those offers that they have made into deals. And I think from a use type standpoint, what we're hearing is, and a lot of this is going to be pocket by pocket. So it's hard in any of our markets because they're so large to just say the market's strong or the market's, down, because there's always parts of our cities where it's going to make sense to go do projects or do deals or stretch on pricing if you have the opportunity to find a land site or development site. But what we're seeing in Austin right now is towards the tail end of this quarter, multifamily activity has picked back up with more of the blue chip kind of like local, very experienced developers that they're always going to be in the market. They're always going to be looking for sites, but they had been offering on fewer and fewer sites the last 12 months in Austin. They're really back wanting to look at deals again, make offers. And it's everything from suburban to really core urban multifamily sites. And we're also just seeing sites become available in some locations where you just really thought that there'd be no way to go get a deal, go get a land site in some of these locations. And I think that's the benefit of the type of market that we're in right now. I was talking to a Dallas-based multifamily developer that just hired a Austin lead to go start an office for them. And they were saying that although Dallas and Houston are markets that they're focused on, they're actually going to be focused mostly on Austin right now because they have capital and they feel like this is the time to go build a pipeline of 5 or 6 deals in Austin, whereas the past couple of years, there was just very little land availability. And so people were stretching on price. They were going further and further out. Now there's a lot of these deals that were acquired that they're either going back to the bank or developers are just having to unload them because they have so many sites on their balance sheet and they can't go break ground. So there's a big opportunity. And I think our team in Austin is starting to see just increased activity and maybe seeing some of that spread of bid ask to narrow a little bit on the multifamily side.
Yeah, that's really interesting. I definitely am bullish on Austin, over the next couple of years. It's going to be tough for maybe the next 12 months or so, but I think when you're a developer, getting in when everybody else is out is really smart. If you have the capital to do that, which a lot of groups won't have that capital. They can't go take down sites and sit on them, but there's a couple groups that can. They'll do well with those deals.
And I think even other use types like industrial, I was meeting with a developer just this week, actually here in Dallas, that was talking about a big project they're breaking ground on in Austin by Tesla. And so there's definitely locations that make sense to still go build. There's areas that are oversupplied for industrial, and then there's areas that are doing really well for industrial. And some of that's product type, and some of it's just the amount of supply that's in the market. And single family, it's so hard in Austin to go get lots on the ground because you're dealing with, probably from the state of Texas standpoint, just a lot more challenges. You have a lot more topography. You have more environmental concerns. You have more soil concerns with rock and just different things you're dealing with. And so I think that the single family activity has remained strong just because it's difficult to go get lots on the ground and there's still such a demand for lots.
Yeah, there's a lot of natural barriers in Austin that you definitely don't have here in Houston. We have floodplain issues in Houston, but not the same issues in Austin for sure.
So last week, Trey and I talked a little bit about what we thought the most active use type was in Dallas, and we were kind of going back and forth between multifamily and industrial. And I thought it might be interesting to continue that thread, but actually talk more about Houston versus Dallas right now, just because the last several years, it was really more Austin versus Dallas. And we would have meetings and clients here in Dallas that would be looking at other places in the state. Very rarely were saying that they were going to Houston or looking in Houston. And that's really adjusted and changed. And so I'm sure you guys are feeling that and seeing more, maybe not even out of state, but just more of the developers that had kind of backed off Houston or not been as aggressive start to come back into the market and be more aggressive again.
Yeah, we're definitely seeing that. I think it's always the groups who have the foothold in the market that are probably the most aggressive and the most real. Whenever people come into the market from outside, there's challenges just to understand the market and to go get the right deals. But we are starting to see that. And I think it's hard to compare Houston and Dallas. I mean, Dallas, there's no question there's more momentum in Dallas. And I think we'll see, a larger number of transactions and just deal volume and units go in the pipeline from a multifamily standpoint in Dallas. But Houston has been a missed opportunity for a lot of groups the last couple of years. And there's really strong fundamentals. And so I think the groups who are paying attention to Houston are seeing opportunity and really jumping on that. And we've seen a significant increase in offer volume in Houston the last 3 months as we've started this year. I mean, there are some groups who are putting out, maybe a half dozen offers a week, every single week on Houston deals. And I wouldn't be surprised if they do 15 or 20 deals this year. I mean, that's the kind of volume we're talking about in certain parts of the city, mainly the suburban parts of the city right now.
Houston, I think, is just really hard for developers to understand that aren't familiar with it, or that maybe have developed there but aren't one of the local developers. I mean, in Houston, there's a couple multifamily developers that have always kind of controlled the market from a supply standpoint, and it's Alliance, it's Odin Hughes, it's Trammell Crow, and there's others. But, they're always doing deals, and when the market's hot, like you said, they're doing 10 or 15 deals, which you don't really see that in a lot of other markets, that there's individual developers that are doing that many projects. In Dallas, you have JPI is that type of a developer, where they build, way more just from a unit standpoint than really anyone else. But when we talk to developers in Dallas about Houston, I think they just really have a hard time understanding the market. And it's from a capital standpoint where they're thinking about just the concerns with over energy exposure, but then also it's the lack of zoning. And so I'd be interested to hear maybe how you guys sell around that, or just if that's less of a concern right now because the fundamentals are so good. And so people are kind of just putting those two concerns to the side and are just back trying to do deals again.
Yeah, we never really hear people that are worried about oil prices or the energy exposure, probably because if they're going to come talk to us, they've already got comfortable with that. Or, oil has actually been okay for a while. It's not like great. I think we're in the 60s per barrel right now. So it's not great, but it's not bad. And when oil prices are down, significantly, if they're in the 30s or something, which has happened several times in our career, then that's a big headwind, and you really can't get past that in Houston. But we don't really deal with that as an objection typically on Houston deals. I think the big challenge in Houston is probably from a utility standpoint, finding sites with utilities that have a good mud rate in the suburbs, because we have some really high mud rates, and the overall tax rate can be 3.5 to 4 in some places. Getting below 3 can be a challenge. So you have that issue. And then we're also just a strange market because of the lack of zoning. You actually have some areas where there is zoning, some of these little small towns where there's zoning. And then you have all these different submarkets in a huge MSA where you'll have a good submarket next to a bad submarket. And so, we know the city so well. We know, all these different areas. We understand that sometimes being across the street can be a big difference in the rents you can get, or being just, a mile over can really matter. And so I think to your point, we were coming into the city and you're trying to figure it out. There's areas where generally you can get comfortable. Like, Cypress right now is a really good market. Katie's always been a good market. In the infill market, the Heights is really strong, but it's a very complicated city to understand. And it's a hard city to learn. I think we've had a lot of developers come in and do a deal or two and not do that well and leave, or come in and say they're going to do a number of deals and not do any deals, but look at a lot of deals and tie a couple of deals up. So it's really been the groups that have been here long term that really know the city and that really study it and pay attention to it. They're the most aggressive, and then end up having the most success.
Yeah, it's interesting you say that about energy, because that's such a common kind of negative comment that's made up here. But I always wonder if it's almost more of just justification for not going into one of the largest cities in the U.S. and developing. Yeah. Because from my perspective, it really does not make a lot of sense not to go and try to develop in Houston. It's such a large city with the port, with the growth, with the ability for it to continue to grow, even though you do have the utility challenges. Houston's done a good job of figuring out how to do MUDs to get utilities to a lot of these further out areas. And it's such a unique city that, I think that when the market's good, you do have everybody kind of tend to want to flood back into it.
Yeah, and I mean, we're also buying land in Houston as well with Ascent. So, from my standpoint, I'm not very worried about energy prices. I think they're going to be stable. You're going to have times where they pull back, and we've seen that. I've been doing this for 20 years now in Houston. We've had times where oil's really pulled back. We've had negative oil prices, which nobody probably thought was possible. And we've always bounced back from that. Those have always been very short term, 6 months to maybe 2 year kind of time frames where it's been an issue. We're a much more diversified city than we've ever been. So I think that, like you're saying, it's an easy excuse, and it's definitely a real concern that groups have and that capital has. But it's not something that I'm very concerned about, being a significant long-term impact on fundamentals.
Another concern, and this would be market-wide, but that we've run into in Q1 has been tariffs, and has been people talking about what is the impact of tariffs going to be. And I'd say it's early from the standpoint of we haven't really seen an impact yet. And I haven't really seen it even enter into negotiations or contracts, or at least not in a meaningful way. But we've been talking to clients about it, and I've had a couple interesting conversations recently with some groups that are very active in the market. They're doing deals, they're building sites. The first was a multifamily developer, and they just closed on a site with us here in DFW. And so we were asking them, because they build their own deals, and they have been able to figure out how to build deals really probably for cheaper than really anyone else out in the market. They've just really figured out their product, and they're doing a really good job. And so they've been able to stay active. But we asked, are tariffs going to have a big impact? And I thought it was interesting because he shared that they, like on the last 2 deals they did, they bought all of the lumber already. So they've already gone ahead and pre-purchased that. And then they've gotten with all of their subcontractors. And what they found from their subcontractors is the majority of the supplies are coming from the U.S. They've already made that adjustment. And so they're not expecting that there's going to be much of an impact. There could be some impact, but not a significant impact. And I got a similar feedback from an industrial developer. And with industrial now, you're talking more about the impact of steel and wood are obviously two of the tariff, could be pretty impacted by tariffs. And what they said was interesting, that they also don't see it as much of a concern. They said 80% of the steel is already coming from the U.S. There's some like small kind of specific steel parts that aren't, but now there's already companies that are relocating to the U.S., signing leases. And they actually said, from a Houston perspective, the tariffs have kind of caused this rush on space. And so they're seeing all this space right now get snatched up by these international companies that are wanting to lease space in Houston on like a 5-year term, because just with the current administration and the length of that term, they want to have a footprint in the United States. So I thought that was really interesting. And the other comment they made that was interesting was, we had such inflation during COVID where everything was so expensive. They were like, no matter what happens with tariffs, we don't see it ever getting close to what that was like. We just don't see it pricing push that much. And so that was interesting. And I thought it was really interesting related to Houston, because they said they just signed a bunch of leases on buildings they had, and they're very bullish. And actually the tariff situation seems to be benefiting Houston in kind of a unique way.
I think it's a very interesting point. I think it's going to benefit in industrial for sure. Like when you're talking about the Austin industrial market, I think that when you have the tariffs that are going on, especially with China, we'll see more and more onshoring happen because of that. And that's going to really drive industrial absorption in Central Texas and probably across the state. But I think I'm not concerned about tariffs at all, at least where we sit right now. Lumber hasn't gone up at all. It's like at 380 right now. So, it's not moving. It's very low. Maybe it's going to tick up a little bit. We saw, to your point about inflation, it was at 1,600, after COVID, when we saw a lot of inflation, which was devastating to construction costs. And so, I think we'll see concern about it, a lot of talk about in the market. But I really believe that we're going to see a lot of this blow over as we get to the back half of this year. And a lot of it will get worked out with different countries. I think the intent of the tariffs is to try and create a negotiating position for Trump. And so I think that there's deals will be made, and it's not really in anyone's interest to have an extended tariff war. It could happen in some cases, but I think we'll probably get past a lot of it. And like you've talked about, as you've talked to developers, there's probably to some extent some groups who aren't active, who are struggling with capital, because we're seeing that. We're seeing the groups who are very active, who have capital, who are doing deals. They're very real. And then we're still seeing groups who are saying, I can't get anything done.
Yeah.
I can't get capital. Nobody wants to talk to me, and they're on the sidelines and they're laying people off. It's kind of sad. And I think there are some groups who want to have the glass half full view, and they want to find the negative headwinds to talk about. It's kind of an excuse for why they're on the sidelines. And so I think those are the groups who talk about that. The groups who are active are not even like tariffs. It's like, what are you talking about? Like we're looking at this as a couple of year, project, not as a couple month project. And so we're just going to go get aggressive. And we see so much momentum in the market. I don't see the tariff issue being a real issue at all, even though I'm sure in some sectors people are concerned about it.
That's a great point, Tim. And you made the comment the other day about our business is nuanced. And so I'm sure there's people listening to this, and we're talking about deals and we're closing deals, and it's been a really active first quarter. There's a lot of groups out there that probably haven't made an offer this quarter. And it's because our business is, depending on the developer, depending on their capital situation, that's going to kind of tell you everything. And maybe even depending on the actual development acquisitions person in that role and how aggressive they are in their connections and their network. But it's probably applicable to the 80-20 principle, which is like in all of life, there's 80% of the market right now is still really having a hard time getting capital, doing deals. But the 20% of the market that's doing the deals is doing 80% of the deals. And that's really consistently how it is. And I've been telling people in DFW, it might be more like 90-10 or 95-5. Because there's so many, it's such a competitive market. There's so many developers that want to do deals in DFW. We track over 400 multifamily developers that want to do projects in DFW. But the reality is when we get a core listing and this client says, I want you to go out to, 20 buyers, a lot of times you have a hard time really coming up with more than 20 buyers that are real buyers for that listing anyways. And that's what's kind of funny. And, when we'll be pitching a deal to get business and someone says, we send our sites out to 2 million prospects. Yeah, that's right. The reality is there might only be like 20 really very good developers or buyers for a specific site. And a lot of that is just capital. I mean, our business, and we'll probably do a episode on this, our business is really hard to understand because there's a lot of people that have no problem giving you an offer on paper and tying your property up. And they have no more business doing that than just somebody off the street sometimes that really, has never built anything, doesn't have capital. So it makes it very nuanced. And then I think it's the stronger buyers right now that are really able to take advantage of what we're seeing in the market.
Well, and that's the danger, I think, for a seller in this kind of a market where things are really starting to come back. There's aggressive offers being made. To your point about the 80-20 rule, which is so true in every area of life, but I think right now it is more of a 90-10, where 10% of the developers are active and can get deals done. 90% really are not active, and the danger is there's probably maybe 30% of that 90% that aren't active that are acting like they're active, and you have development guys who are out putting stuff under contract and having meetings and throwing LOIs around, and they really don't have any traction on the capital side, but they're just trying to get some kind of traction. And so if you're a seller and you go, bite off on that and you go take the little bit higher deal with a weaker sponsor, there's a good chance that doesn't pan out. And maybe they do close, maybe the market's frothy enough that they get it capitalized, but maybe you're sitting there 9 months later with a deal that's dropped, and then the deals around you have happened, and now there's a concern about supply. So this is every market's challenging, to make the right decisions, and it's challenging for different reasons. But as much as there's a lot of excitement, I think being smart about the decisions you make as a developer or as a seller, it's critical as always.
We'll leave this point, but the last thing I'd say is just that's actually a huge value add when we're talking to sellers about the value that we add. And I think a lot of times the sellers just don't understand the value of when we look at 10 offers and we stack up those groups, we know where their money's coming from. We know their track record. We know what other deals they're pursuing and chasing. And that's so valuable because a lot of times all you're looking at is numbers on a page. And if that's what you look at, you're going to pick the wrong offer. And it's, that we'll get into that on another episode, but let's transition into something that's always fun to talk about. Let's talk about some specific deals from the first quarter. And, last week, Trey and I talked about several Dallas deals. We had some pretty big closings in other markets in the first quarter, some big deals that are moving forward. I know you guys had some pretty big multifamily closings. Do you want to mention a couple of those?
Yeah, I was just going to say there's always a friendly competition between Tom and I, since we're brothers, between the Houston and Dallas offices. And fortunately and unfortunately, Dallas is in the lead right now. So you guys have had a really good first quarter. And we've had closed a number of deals here in Houston, I think 7 or 8 deals so far. We've had a couple deals pushed to next month. So we're just loading up the second quarter so we can beat you guys. But yeah, we've had some multifamily deals close with Trumbull Crow and Alliance in some really good markets, one down Missouri City, one over in Cypress, where there's some barriers to entry. And especially Missouri City, there's a lot of barriers to entry. That deal is in a master planned community, and I'm excited for them. They got a good basis on that deal. So these are deals that are capitalized. They're ready for construction or to go into construction. So that's another transition point we're seeing in the market, where the last 2 years we saw groups looking at maybe taking land down and not being quite ready to start construction, trying to work on construction post-closing. Now we're seeing groups, getting financing and being able to close into construction loans. So we're seeing that, some good industrial activity. We closed an industrial deal, I think a couple weeks ago. There's a good suburban industrial deal, and then a big single-family deal with 4-Star. So we're seeing a lot of transactions on the single family side, and hopefully a couple of big ones will be closing in the next couple of months here in Houston.
Yeah, that's exciting. I have to say, you guys did beat us on offers, or are ahead of us on offers so far. So I think our competition is that we like to be ahead in every category. So we have some work to do here in Dallas to catch up on that. But it's been really good to see just how strong the Houston market is, and it's specifically just how strong the activity you guys are having. Because we're competitive, but we like to see each other be successful. So you guys are having a really good start to the year. We're really excited about the start we're having up here, and it's exciting. We also had some unique closings in the first quarter. We closed another deal in Colorado, kind of in the Denver area, a deal we worked on for actually quite a while, because that's a complicated market just with utilities and water rights. But another deal that we had closed out there in that market. And then we had a really large deal that's moving forward that is actually one of our Ascent deals in Central Texas that we're excited about, several hundred acres. We have some buyers on that are moving forward, went hard, and moving into kind of their closing period. So really, really bullish on just activity that we're seeing. And actually with Ascent, we have a big fund closing coming up, which I guess by the time this airs, we'll have already closed. But that $100 million fund that we're in the middle of raising, we'll have closed at about $82 million on our first closing. So really excited just about that. We just went out and started raising that about 2 months ago. So really excited. We have a couple deals that we're already going to be purchasing to put into that fund. And like you said, we're really pretty aggressively looking across the state right now at these opportunities. Let's talk about what we're expecting in Q2 and just kind of some predictions and, maybe activity and just anything that you're thinking may be the same or different from Q1.
I think one of the biggest things we'll see, we talked about, kind of the split between developers who are active and who aren't active, especially as it relates to multifamily. I'd say on the single family side, almost everybody's active. But maybe industrial, multifamily, we're seeing kind of that, maybe 10% or so who are really active and really real, and then there's a lot on the sidelines. I think we're going to see that shift to more of an 80-20, and probably at some point this year more of a 50-50, where you have groups who've really been on the sidelines who are actually actively back in the market, and they're able to get capital, and they're likely to do a deal or two. Maybe they're not going to do 10 deals, but they may do a deal or two. You may see more of that in Dallas, because I think Dallas is a market where the groups who might do a deal or two here might do 4 deals in Dallas, or 5 deals in Dallas. But I think we're going to see that really shift. And it's always that way. Early in the market, there's the kind of the market leaders, what we call the tier 1 groups, who they go out there first, they tie up the deals, they end up getting probably the best deals because they're early in the market and they can get them capitalized. And then once they get out there and kind of get ahead, a lot of groups start to follow them. And we start to see the market kind of open up. So that's one kind of prediction I would make. Another prediction that I think shows how strong the market is we're starting to see some multi-phase takedowns in Houston for multifamily deals, which is really a sign of how strong the market is. I mean, no one really ever does that. I mean, most multifamily developers, almost all the time just buy one phase at a time because buying two phases and holding land is very challenging. But we're starting to see that. We're starting to see some big pricing being paid for multi-phase sites. Are you guys seeing that in Dallas at all, Tom?
We're seeing that a little bit. That was, when we first really became active up here in the market 5-6 years ago, when the market was really hot. That was a big surprise to me, was just how many developers up here were taking down these like multi-phase wrap sites, because I hadn't seen that, very often in Houston. And then that went away. And a lot of that was just capital, and that's normally driven by, is capital willing to do that? Can they capitalize that second phase into maybe the first phase project, or figure out a way to do that? We're starting to see it a little bit. I would say right now, there's some groups that are trying to differentiate themselves by being willing to do that, but it's definitely not market wide that groups are willing to do that. We do have, and I know we were talking about this earlier, just in the last couple of weeks, we've signed up several really good listings. And actually, in a couple cases, some deals where we're teaming together, a couple developer clients of ours that have sites in Houston and Dallas that we're going to be bringing out their sites in both markets. And we have a couple of situations where sellers are wanting very quick timelines on closing. And that's something we definitely have not seen the last couple of years, or we haven't seen an ability for the market to pursue those type of opportunities. But some of these sites are really well located. And so it's been a little surprising that, there are buyers out there that are willing to go pursue these quicker closings. And these aren't just, kind of bottom feeder investors. These are developers. They're going to try to push the numbers as much as they can. But there's an ability to maybe buy and hold some land, similar to what you would be doing with a multi-phase project. But if you're having to close on a development site in, 3-4 months, you're going to be holding that for maybe a year before you can develop it. So we are starting to see developers more open to that, and that hasn't been the case.
And that's probably something that a lot of people wouldn't believe. If you were talking to just a typical developer in the market, they'd say that's not real, that doesn't exist. But it is. It's very real. We're seeing that in Houston too. It's rare. There's not very many groups who can do that, but there are groups who have capital, and they have such strong capital relationships that they're ready to go do the right kind of deal. So if it fits a certain parameters. In some cases, these deals are the hotter deals, and so you have to be able to go move fast and just close them, just to be able to win the deal. And so we're starting to see that. It's definitely in Houston. It's not common, and it's less than a couple of groups. It's like 2 or 3 groups who are doing that. But there are groups who can do that, and it's probably the time in the market where you start to see that early on. And then once they get a couple of deals, they're not going to do that anymore. They'll want typical timeframes. And then maybe late in the cycle, you might see some more of that when it just gets really frothy and you have to do that to win deals. But yeah, that's been an interesting development that we've seen.
I think just in general, probably can wrap with this unless you have any other predictions, Tim. But I think piggybacking on what you said, I think I expect activity to be stronger in Q2. I think both from a closing standpoint, hopefully some exciting announcements when we do this again in a few months and talk about some of the closings we've had, just some pretty exciting big deals that we can't talk about yet until they're closed. So I think from that standpoint and just general activity, we're going to have a lot of good metrics with listings out in the market and several really well-qualified developers that we're representing on the buyer side, just to see where some of this activity is coming in, but projecting that it should be a very strong Q2.
I agree with that. I think we'll see a much stronger Q2 than Q1. Even though Q1 was strong, I think we'll see a lot more groups getting back in. We'll see more sellers actively pushing their sites out to market. Just in general, Q2 is always a really good time in the market. People kind of warm up, for the first quarter, and then they really go work hard before summer. One thing I would add as a prediction, I think we'll continue to see industrial pricing go up. And so I don't know how this would compare to Dallas, Tom, but in Houston, the last 2 years, we saw industrial pricing really fall. So back in 21 and 22, it got really high. We were seeing, good suburban sites get into the teens on pricing. And then it dropped quite a bit. I mean, we saw a lot pricing go down to maybe $5 to $7 a foot. A lot of deals just didn't transact because of that. We saw it start to creep up fourth quarter last year and first quarter this year, kind of into that probably 8 to 10 range on the good sites. And now we're seeing it start to push into the double digits. So 10 plus, even back into the teens on some of these sites. So that's really interesting to see, just how strong that market is. And it's definitely coming back in a pretty big way.
Yeah, no, that's good. Yeah, Dallas, we've had some just mind-blowing comps on the industrial side. There's what happened in Dallas was when the market pulled back because of interest rates, developers really moved in and everything just needed to be very core, but there was still a lot of demand. And so actually we saw some deals trade north of 30 a foot for industrial that were, 15, 20 acre sites, just crazy.
That's incredible.
Yeah, crazy activity. You're talking million hard day one, those type of deals where zoned industrial in a really good location, like close to the airport. We saw some really strong activity, but that was just because there's not many sites like that. So that's definitely the top of the market. Prior to that, probably the strongest pricing had been like low 20s that we had seen back in like 2021. So what I've been telling people that's really interesting is pricing has not gone down the last couple of years on the really good sites. So again, it's the nuance of our business. On the really good sites in the areas where there's capital, the pricing actually went up because you took all the developers and they were all focused on those sites. So now there's way more competition. No one was focused on those suburban tertiary sites. So there's just like no activity. The big shift this year has been that now the industrial activities really moved back to the suburbs again. And so those areas that just weren't getting offers, a lot of those sites fell out. Now those areas are starting to see prices creep. So there's a suburban area in Dallas that everything was kind of priced in that $7 a foot range. And now we're making offers up there in the $15 to $18 a foot range, just because there's so much more activity again. And, it's a herd mentality and it's demand and supply. And so if you get so many people demanding something, naturally pricing is going to go up.
Yeah, we were seeing that in the 290 corridor out in Waller, where pricing, no one even wanted to touch it probably the last 2 years. And now we're seeing pricing go from probably what they may have offered 4 to 5 a foot to maybe back to 8 to 10 a foot out there. So that's a great point. Whenever you see developers come back to a market in strong enough numbers, you can see the pricing really move. And so that's just a part of Houston where you can actually go do big deals. There's still a lot of land out there. It's priced, relatively reasonably versus other parts of Houston where it's just been picked over and the good sites are already gone.
Well, Tim, good luck in Q2. I think we'll be out trying to compete a little bit, not do each other, but I think both of us are expecting to have a really strong quarter, and I think we'll see a strong quarter just across the state. We're excited about.
Yeah, I'm excited to talk. We'll have to get Tripp on, maybe get David on for the Q2 roundup, and I'm really excited to kind of talk about where we are at that point. So
looking forward to it. All right, thanks, Tim.
All right, thanks, Tom.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.